Overconfidence and ego in investing. Investing is as much an art as it is a science. It requires a deep understanding of markets, a thoughtful strategy, and, most importantly, a keen self-awareness. However, two psychological pitfalls, overconfidence and ego, frequently derail even the most experienced investors. This video aims to unpack how these biases influence investing decisions, explore their consequences, and offer actionable strategies to combat them. Let's begin with overconfidence. This isn't just a trait, it's a cognitive bias where individuals overestimate their abilities or knowledge. In the world of investing, overconfidence can manifest as an inflated belief in one's ability to predict market trends, pick winning stocks, or time trades perfectly. You've probably heard the saying, knowing what you don't know is more important than knowing. Overconfidence blinds investors to this wisdom. It creates an illusion of control, leading them to believe they have the power to predict market volatility or fluctuations with precision. For example, take a corporate professional who feels their industry expertise makes them a natural at predicting stock trends in related sectors. While that knowledge offers a foundation, markets are influenced by multiple external factors, including global economic conditions. Overconfidence in one's field-specific insight can result in significant financial losses. Moreover, overconfidence often leads to excessive risk-taking. An investor, emboldened by a recent success, might double down on trades or fail to diversify their portfolio. By placing all their eggs in one basket, they increase their exposure to market vulnerabilities. Now let's talk about ego. Ego is the protective shield we build to safeguard our self-image. When applied to investing, it blocks us from admitting mistakes because doing so feels like a personal failure. However, this reluctance to face reality can have damaging effects. Imagine an investor holding onto a losing stock, convinced that the market will eventually catch up. This is ego at play. The refusal to sell stems from the fear of being proven wrong. In reality, the longer they hold, the worse the losses become. In many cases, ego keeps investors locked in a cycle of loss, doubling down on bad decisions in the hope of eventual redemption. Ego can also drive someone to seek validation through risk. They might hold on to positions not because they believe in long-term value, but because selling would mean admitting defeat. Or they might over-leverage their decisions to gain recognition from peers or colleagues. Both approaches result in increased exposure to market downturns. In essence, ego fuels a fixation on being right, overshadowing the primary goal of investing, building wealth sustainably. Why do intelligent, experienced professionals fall into these traps? The answer lies in human psychology. Investing involves a unique mix of logic and emotion. While numbers may drive investment decisions on the surface, emotions like fear, greed, and pride often play an underappreciated role. Overconfidence stems from optimism bias, where people believe they're less susceptible to failure than others. It provides a false sense of security, encouraging decisions based on anecdotal evidence rather than hard data. Ego, on the other hand, emerges from cognitive dissonance where a person struggles to reconcile conflicting views, like knowing that a stock is declining but wanting to hold it to prove a point. Together, overconfidence and ego create a fog of irrationality, making even seasoned investors prone to flawed decision-making. To illustrate the damage these biases can cause, let's examine some real-world examples. In the dot-com bubble of the late 1990s, a wave of overconfidence swept across investors. Many believed that any internet-based enterprise was destined for success. They poured money into companies without understanding their business models or long-term potential. When the bubble burst, investors were left grappling with massive financial losses. The underlying issue? Overconfidence in a trend blinded them to risks. Similarly, consider individual cases of portfolio mismanagement. For example, an investor who keeps hold of declining assets because of ego-induced reluctance to admit they chose poorly. They might miss opportunities to reallocate their capital into more promising ventures, further compounding their losses. One of the first steps to mitigating these biases is self-awareness. Let's look at the signs of overconfidence and ego impacting your decisions. Overconfidence indicators. Frequent overestimation of your knowledge or skills. Reliance on intuition rather than objective analysis. Excessive risk-taking and under-diversifying your portfolio. Ego indicators. Refusal to sell losing investments due to a fear of acknowledging mistakes. Seeking validation through high-stakes or ego-driven investments. Difficulty accepting constructive feedback from peers or team members. If you recognize these behaviors in yourself, it's time to make changes. Thankfully, these psychological pitfalls are not insurmountable. By adopting a disciplined, systematic approach, you can make better decisions and minimize emotional interference. Here are several strategies you can implement. Investing is as much about self-improvement as it is about market analysis. Keeping a journal of your investment decisions, along with the reasons behind them, can reveal patterns over time. Are you basing trades on solid data or hunches? Are you ignoring red flags? Reflecting regularly helps pinpoint areas for improvement. Track your investments based on measurable KPIs such as returns, risk-adjusted ratios, or historical performance. These metrics provide an unbiased snapshot of your portfolio's health, keeping overconfidence and ego in check. Diversification acts as a fail-safe against overconfidence and keeps your exposure to risk at manageable levels. By building a well-rounded portfolio spread across sectors and asset classes, you reduce the impact of any single bad decision. Ego can be a stubborn adversary, blocking us from admitting when we're wrong. However, admitting a mistake early is a strength, not a weakness. It allows you to cut losses and redirect investments into better opportunities. Selling off losing stocks or revising strategies is a sign of maturity in the investing arena. Surround yourself with a team of peers or mentors who can challenge your assumptions and offer alternative insights. Actively seek constructive criticism, not validation. This collaborative approach prevents your ego from dominating decision-making. Adopting a long-term perspective helps you steer clear of impulsive, overconfidence-driven decisions. Instead of being swayed by short-term market fluctuations, focus on broader trends and sustainability. This approach aligns your decisions with your financial goals. It's important to note that confidence itself isn't the enemy. It's overconfidence without caution that creates problems. Confidence is what empowers investors to take calculated risks, tackle challenging markets, or hold firm during downturns. But this confidence must always be tempered with humility, data-driven analysis, and a readiness to revise one's approach when necessary. The same balance applies to ego. While a certain level of pride in your decisions is natural, it must never cloud your judgment. Healthy ego respects the need for learning, improving, and evolving. To master investing, one must also master resilience. Markets are unpredictable and setbacks are inevitable. What separates successful investors from the rest is their ability to adapt and bounce back. Here are some tips. Stay objective. Separate emotions from facts by establishing clear, measurable goals. Learn from failure. Treat every mistake as an opportunity to strengthen your strategy. Maintain discipline. Stick to a predefined investment plan, even during moments of doubt. Keep educating yourself. The more you understand about markets, the better equipped you'll be to navigate complexities. By now, it's clear that overconfidence and ego are among the most perilous pitfalls in investing. Yet they are also manageable. The key is to consistently practice self-awareness, question your assumptions, and align your decisions with data and measurable outcomes. In the world of investing, psychological mastery is just as important as market knowledge. Recognizing and addressing these biases leads to smarter decision-making, more resilient portfolios, and most importantly, sustainable long-term financial growth. As corporate professionals and investors, your greatest tool is not just your skill, but your mindset. The journey to wise investing begins with understanding your own biases, especially overconfidence and ego, and making deliberate efforts to mitigate their influence. By mastering these psychological obstacles, you can unlock your full potential as an investor. Remember, the ultimate goal is not to be right, but to be effective in achieving financial success. Let humility, discipline, and education be your guiding principles. The better you understand yourself, the more powerful a force you'll be in the investing world.